Hello everyone and welcome to our January market evaluation webinar. The aim of this webinar today is to provide an update on what has happened in financial markets over the last quarter and year and how those changes affect the expected returns and portfolios that are updated each quarter based on the eValue asset model insight. With me today are Tim Jablonski, eValue's consultant actuary, and Salman Ansari, a senior member of the eValue asset modelling team. I will now hand over to Tim to provide an overview of eValue's approach to asset modelling.
Thanks, Gemma. The eValue asset model insight is an economic scenario generator. Its output is many thousand different paths of how the economies of the world might develop and the asset returns from the major asset classes that are associated with each of those scenarios. They're used in all our tools, these scenarios, to produce projections of possible outcomes of investments in the hands of consumers, as well as to optimise portfolios for each different level of risk that a consumer may be prepared to take. So we've been modelling investment markets since 1993. That's over 20 years of experience in building economic scenario generators in order to forecast investment markets and optimise asset allocations. The purpose of this bulletin is to provide financial advisors with an independent commentary on investment markets and the background to, well, the changes we've seen over the year and what that means for the next set of quarterly returns, so that these can be communicated to clients. We tend to stick to a medium to long-term view. Our independent approach is designed to make sure that we don't get caught up by a single idea, no matter how interesting, and instead systematically consider the range of possible outcomes. So, as an example, at the present time, we recognise that record low interest rates mean that future fixed income returns will be pretty meagre, and the effect of a return to past high interest rates might well create havoc and substantial capital losses on fixed interest bonds. However, we must also consider the possibility that falling inflation, negative interest rates in other economies, and weak productivity growth could mean that rates can stay low or fall even further, and there's a chance that bonds may not be such a bad investment after all. Right, some of the key requirements of our economic scenario generator. Any model that's used for any purpose should be fit for that particular purpose that it's to be used. It seems a bit like an obvious thing to say, but it's very important that the purposes are clear in order that when the model's built, the most significant elements, requirements and characteristics can be taken into account and the right model is built. For our purposes, you can see the 6 of our key requirements on your screen now. So for our purposes, we're considering the outcomes of investments to achieve investors' goals. Now for this, it's important that we model inflation consistently with asset returns. So strong asset returns are of little value if their purchasing power is eroded by inflation. Similarly, for many investors' long-term goals, the future income that their investments will generate is as important as how much growth they've achieved. So we model both growth and capital growth and income, and then we combine them to make a total return. Since in a lot of our tools are consumers typically investing now, they're exposed to the rates and yields that are available now. As these economic conditions change, our model must update to consistently reflect these changes. And we live in a global world, if you excuse the tautology. And so investment markets and opportunities are global, as we know and see. So to reflect the breadth of opportunity that's available to an investor, we present a consistent global model of all the major investment markets, as well as an exchange rate between them, so that the returns on the investor's own currency can be seen. And finally, our model reflects the fact that different investors have different time horizons, and the risk of different asset classes varies by time horizon. For example, holding cash is clearly the lowest risk asset to hold if you're worried about fluctuations in the short term, so over the next month or year. But as the investment time horizon increases, so does the uncertainty of the total return that you may achieve on cash, whilst the uncertainty of the total return that might be achieved on a bond reduces at the same time. Our model reflects this behaviour of risk in the returns. So there are some of the key requirements that sit behind our model. They're in our mind when we build it. Right, this shows the model structure, this slide, and it's in many ways it speaks for itself, but I'll talk you through it anyway. The basic structure of the model is to model the possible progression of the economic variables, which are on the left-hand side, and then to translate these into the returns on asset classes that we're familiar with. That's those on the right-hand side. In order to achieve the key requirements that we have for our economic scenario generator, our key starting point of the model is the possible progression of interest rates from their current levels into the future. We have separate models for the government fixed interest, the nominal fixed interest rates, and real interest rates. The progression of the future interest rates gives the expected future return on holdings of government bonds, as well as cash, and the difference between real and nominal future interest rates gives the expected future inflation. In addition to the interest rate models, we have an equity dividend yield and growth rate model, which gives expected equity returns. We have a corporate bond return, which shows the interest rate behaviour correlated to government bonds, as well as an additional risk linked to equities. And we have a property rental yield and growth model, which gives expected property returns, and we are looking in particular at a portfolio of commercial property there. Each of these models is calibrated in 4 major currencies, so sterling, US dollar, euro and yen, and the exchange rate model between these currencies allows us to express these returns in the currency of the investor. Right now, over to Salman.
Thank you very much, Tim. In this part of the webinar, we will look at how the economic indicators have changed over the past quarter and how these changes are reflected in our asset model insight in the form of changes to returns projections. As this update comes at the end of the year, we will also summarize what has happened over the past year and say a little bit about what we think will be happening next. So we'll start with the interest rates and then move on to other assets. As noted already, interest rates are the cornerstone underpinning asset price movements. On the chart that you can see right now, we've got 10-year yields for various economies. In December, the US Federal Reserve finally raised its policy rates for the first time in almost 10 years. This caused a late recovery in rates at the back end of last year compared to earlier levels, but rates ended up more or less where they had started early last year. The UK is unambiguously in wait-and-see mode, with Mark Carney saying the economy is too weak to contemplate a rate rise just yet. On the one hand, employment performance in the UK and the US appears to be strong, however it is measured. But on the other hand, wage growth is low and both economies are gently slowing down from unspectacular peaks earlier in the year. At the back end of last year, after the US Fed rate rise, investors in the US were expecting quickening growth and further interest rate rises, thus pushing up yields. While in the UK, bond yields also rose on the back of, amongst other factors, the biggest jump in house prices in 8 months, signaling that this sector of the economy still remains resilient. As of yesterday, however, US Treasuries were trading at a 3-month low. This, amongst other reasons, was because at the start of the year there was a global rout in stocks all over, and fears over a looming recession meant that investors flocked towards safe assets, and bond prices have rallied, pushing down yields once again. And now suddenly the US Fed rate rise looks like something that happened a very long time ago. Cheap oil in itself is probably good news for most developed economies, but whatever forces are making it cheap may be bad enough to offset this boost. The recent return of Iran to the global oil market has further dampened these markets. For instance, the US stocks of crude oil and other petroleum products are now at an all-time high of over 2 billion barrels. We'll move over to some of the other economies. Japan continues to be subdued, with its already low rates declining even further this quarter. Germany and France have also mirrored the trend that we have seen in the UK and the US, but at a lower level, with similarly vacillating yields over the period. If we have a look at Italy and Spain, they have also mirrored the yields that we've seen in the UK and the US, but unlike the previous quarter, they're generally below what we've seen here. Greece continues to remain an outlier, but has responded similarly over the past quarter to the other economies, albeit with slightly higher volatility. So the upshot of all of this is that yields have generally risen over the last quarter, meaning slightly better prospects for fixed income type assets, although some of this has been reversed since the beginning of this year. We'll move on next to real rates, and here we've got the 50-year real rate for the UK. Note that the vertical axis is actually in reverse, so the higher you go up the chart, the more negative it's getting. A look at real yields shows that these are still firmly negative, and more or less at the levels at the beginning of the quarter, but slightly worse off than they were at the beginning of last year. So what do these negative real rates mean? Well, one possible reason is that the expectation is that nominal rates will remain low for some time to come, or go lower still, or that inflation is expected to rise faster than nominal yields in the future. Or perhaps some people are also saying that quantitative easing is expected. In any case, the pressure on inflation rising remains relatively low, and this is only helped by the low oil prices. What this means for our asset returns is that real returns continue to be hard to come by, and prospects for the index-linked bond type assets remain little changed over the past quarter. Now we're going to have a look at what's happened to equities. We'll begin with looking at them in their local currencies and then move on to looking at them in a single currency, in our case the US dollar. The main observation is that equities staged somewhat of a recovery over the last quarter from the levels that were seen after the Chinese stock market collapse back in August. All major markets have maintained or improved upon their levels at the end of the previous quarter in total returns terms. But as far as price levels are concerned, there still haven't made much ground. Since the beginning of this year, however, there has been more bad news from China, creating another stock market collapse and sending shockwaves around the world. As a result, global equity volatility remains at a high, as we shall see later, and stock indexes have plummeted. In the UK, over the past quarter, the UK price levels for the equity market have not quite made up since the drop that they had back at the end of August. There have been several notable rallies over the period. However, price levels continue to be hit with some sort of resistance. In fact, since the beginning of this year, stock prices have fallen dramatically to levels that were last seen 3 years ago. And if we rewind back to almost 20 years, we can see that we are actually at the same price levels that we had 20 years ago. So things are currently not looking too great, and we'll say more about this a bit later. The US stock market has also rallied since the drop at the end of August, and it has gained more ground than we have here in the UK. However, since the start of this year, it too has taken a hit, triggered by the Chinese stock market collapse. The Eurozone and Japan have also mirrored the trends seen here in the UK as well as in the US, and have been unable to reach their pre-August price levels by the end of last year. AsiaPacific and emerging markets, which were more directly affected by the Chinese stock market collapse, also made some short-lived recoveries during the past quarter, but failed to make up for the ground lost at the end of August to end the quarter more or less where they started it. Now, in order to have a look at what the performance of equity markets have been from, for example, a dollar perspective, it's important to have a look at what exchange rates have been over this period. So we're going to do that by having a look at how the dollar fared against sterling and the euro. So note here that what we're showing are not actual exchange rates, but rather how rates have changed since the last quarter. So you'll see them oscillating around 1. The US dollar has strengthened over the last quarter, while the British pound has simultaneously weakened. And what this means is that the US dollar investor has favorable exposure to downside movements in the UK, for example, but realizes less return when the UK market gains. So if we now have a look at the various indexes that we saw earlier, but now in dollar terms, the overall trends are little changed, but because the US dollar has strengthened against the other major currencies over the quarter, total returns were smaller in US dollar terms. So the upshot for equities from all of this market climate is that equities are slightly improved in terms of asset returns prospects. And although some equity markets are now clearly in bear territory, most are still bullish, albeit marginally. I'll also say a quick word about what's happened to property. Property assets have improved quite markedly over the past year, so their prospects for the future are relatively subdued as much of the yield has already been realized. And now, before we move on to what our asset model insight thinks about the way the economies of the world have gone and what prospects we can project for the future, there are a couple of interesting observations that are pertinent to what's happening right now that we can make. First of all, let's have a look at global equity volatility. For those who were here in our last webinar, we mentioned the VIX index and how it shot up last August in the wake of the Chinese market collapse. So here we have the equity volatility indexes associated with the 4 main equity markets: the UK, the US, EU, and Japan. The first peaks that we see near the middle of the chart coincide with the market crashes back in August. Since then, there has been a slow drop as market anxiety decreased because investor sentiment was pacified. However, just before the Fed policy rate rise in December, there was another increase in the volatility indexes as investor anticipation grew. This, however, was short-lived, and we saw a drop again over the holiday period. However, the new year brought another rout in the Chinese market, and all equity volatility indexes have shot up again. And although it has been a couple of weeks since the New Year out, volatility levels continue to rise and are now nearly at levels that we saw in August. So all of this shows that at best things look a little uncertain for equities. In fact, just today the Chinese markets have lost another 6%, undoing the gains they made in the last couple of days. Another interesting observation is making a comparison between the Japanese economy and other developed economies. Here we're comparing the UK and Japan. We're showing the yields and equity levels that we've seen for the last 20 years or so. The hollow lines are 5-year rates and the solid lines are equity levels. Blue is for the UK and green for Japan. As we can see very clearly, both economies have gone through very similar and simultaneous equity cycles, but now both have very low rate environments. However, Japan has been unable to shake off these low rate environments and has been stuck in them for the last 25 years or so. The UK has been in a low rate environment for the last 7 years or so. So this raises a few questions and a few observations that we need to ponder over. Is it impossible to recover from a low rate environment? If that is indeed the case, is the UK economy heading towards the Japanese economy, and that we are only a few years behind? These questions are becoming increasingly relevant and might indicate what we have to expect in the future. In fact, if this is true, then perhaps the economic situation that we see in Japan may serve as a prescient indicator of what we can expect for the UK down the line. Now let's just move on to what the asset returns projections that we have from our asset model Insight. The main take-home from the discussion that has been presented thus far is that prospects have improved marginally over the past quarter. Equities have not really recovered from their collapse in August, and between lower prices and weaker growth, the outlook is little changed. There are slightly raised expectations for interest rates, but even these are well below what we saw in the summer of last year. Outputs from our model reflect these observations in terms of the asset returns projections, and we will demonstrate these by way of tilt charts like the one we're seeing on the screen right now. These charts show the change in asset returns over the past quarter at various time horizons. A movement to the right indicates an increase in risk, while a movement upwards indicates an increase in return. So the best improvement would be in the top left quadrant, where we would be getting more return at the cost of less risk. So let's have a look at what's happening at the relatively short horizon, in this case 8 years. Most asset returns movements are in the top right quadrant, meaning that there's an increase in return as well as risk over the quarter. The exception is property, which shows a drop in return but an increase in risk over this period. The improvement for cash in this period is the least attractive of the remaining assets, as it is accompanied by a large increase in risk for relatively smaller increase in return. Other fixed income assets have, as we've noted earlier, are more promising, and developed equity is also showing improvement over the past quarter. If we have a look at the longer term, so here we've got 18 years, all asset return movements are in the top right quadrant, meaning that there's an increase in both risk and return over this period. The worst performer again is property, followed by cash, and fixed income as well as equities have come up the best. To summarize what's happened over the past year or so, we've got the year-to-date performances showed in this table. The performance of asset classes has vacillated over the past year. Fixed income type asset prospects have improved slightly year on year. Property prospects, however, have declined. There may have been some short-term gains, but longer-term prospects are subdued. And all other asset returns projections have generally deteriorated slightly over the past year. And this brings us to the end of our webinar.
Thank you all for attending the webinar today. We look forward to seeing you next time.